Welcome back to Investing Talk Podcast.
Today we're looking at Meridian Holdings.
As usual, before we start, subscribe, like, and comment to this video to support the show. Because we are tracking a company right now that is going through, well, the kind of massive structural metamorphosis that usually makes the market hold its collective breath.
It really is. I mean, for anyone who has been ignoring the mid-cap gaming sector, it is definitely time to pay very close attention to what's happening here with Meridian Holdings. They're currently trading under the ticker MRDN, and we are witnessing a top-to-bottom corporate transformation.
Yeah, a complete overhaul.
Exactly. This is a company formerly known as Golden Matrix Group that just pushed through a major rebrand, a severe share consolidation, and a dramatic flip from burning cash to actually generating a net profit. They are essentially rebuilding the engine while the car is driving 100 miles an hour down the highway.
Which is exactly why we need to tear this apart today. Because when a company shakes up its entire identity to this degree, it usually signals one of two extremes for you as an investor. They are either making a desperate final play to stay afloat,
Right.
or they are setting the stage for a massive breakout in the global market. There really isn't much middle ground.
No, there isn't. So let's pivot to the fundamentals and see what's actually under the hood, because to understand which scenario we're looking at, we really have to start with the actual financial health of the business before we even touch the stock mechanics.
Makes sense.
If you look at their third quarter of 2025, the numbers here are, well, they're jarring.
Yeah, jarring in a very positive way, though.
Absolutely. In a single quarter, we saw Meridian Holdings shift from a $3.3 million net loss to a $400,000 net profit.
Let's just pause on that for a second. That is a massive swing. I mean, a nearly $4 million bottom line turnaround in one quarter doesn't happen just because you tweaked your marketing budget. What actually drove that?
It comes down to the successful integration of Meridian Bet. For a long time, Golden Matrix Group was spending heavy capital to scale, acquire, and build out its infrastructure. They were operating with all the frictional costs of a company trying to stitch together different platforms.
As burning cash.
Exactly. But by fully integrating Meridian Bet into the core business, they finally internalized a lot of those costs. The tech stack started working harmoniously. They achieved economies of scale that instantly expanded their margins.
Validating the whole strategy.
Yeah, it validates their international online gaming strategy perfectly. It proves they can actually capture the cash flow investors have been promised for years.
Okay, I hear the optimism, and it's impressive, but I need to push back hard here. Because when you look at the valuation, there is a glaring disconnect.
Okay, let's hear it.
Meridian Holdings carries a $1.08 billion market cap. It's trading around $7.65 per share. But it's carrying a deeply negative PE ratio of negative 189.74. Now, for anyone tracking the math at home, a negative PE ratio simply means the company has no net earnings over the trailing 12 months. They've been operating at a loss.
Right.
So how do you justify slapping a billion-dollar price tag on a company that historically has just been a cash furnace?
It's a totally valid concern, and if you only look at the trailing 12 months, the valuation looks completely detached from reality. But a trailing PE tells you where a company has been, not where it is going. To reconcile that billion-dollar valuation, you have to look at the massive cleanup they just executed on their balance sheet.
The debt reduction.
Yes. They recently slashed their total debt by 37%, bringing it down to a highly manageable $25.9 million.
Wait, how exactly did they retire that debt? Because if a company pays down debt from free cash flow, that's fantastic. But if they just issued a mountain of new shares to pay off their lenders, that 37% reduction isn't a victory. It's just a stealth tax on the existing shareholders.
And that is the critical distinction to make here. This debt reduction was achieved through a strategic restructuring of their liabilities. They were converting specific obligations and cleaning up the books as part of the Meridian Bet consolidation. It wasn't just a reckless dilution spree to keep the lights on.
Okay, that's reassuring.
By getting that debt load down to $25.9 million, they dramatically reduced their interest expenses. That frees up millions in cash flow to pump straight back into their growth segments. And you really have to realize the sheer scale of the operation we are talking about here. This is a massive enterprise with 1,200 employees dominating both the business-to-business and consumer-facing gaming markets.
Let's actually map out that footprint. Because the term global gaming gets thrown around a lot. What does this operation look like on the ground?
The foundation of their entire business model is multi-jurisdictional licensing. They operate extensively across Europe, Africa, and South America. Their primary consumer platform, Meridian Bet, is live in over 15 different countries right now.
That's massive.
It is. But the real value is how diversified they are. They own Expanse Studios and GM, which provide the underlying software for other casino operators. They own MexPlay, giving them a direct, regulated foothold in the rapidly growing Mexican casino market.
Right. And they have assets in the UK and Australia too, right?
Exactly. They own Arkings Competitions, which runs raffles in the UK, and a highly sticky charity sweepstakes asset in Australia called Classics for a Cause. They aren't just relying on one country or one type of gambling.
I want to focus on their B2B software for a minute because I found a detail in their operational strategy that is absolutely brilliant. Their proprietary software platform has a hard-coded, automated system that actively blocks any user access from the United States.
It seems counterintuitive at first, right? Why intentionally block the most lucrative betting market on the planet?
Exactly. But when you look at the regulatory nightmare of the U.S. market, it makes perfect sense. The U.S. is a fractured mess of state-by-state regulations, Wire Act compliance, and massive licensing fees.
A total headache.
Yeah. By building a platform that guarantees zero U.S. exposure, Meridian Holdings is offering a bulletproof product to international operators. If you are a European casino operator using their tech, you do with absolute certainty that you aren't going to accidentally trigger a massive lawsuit from the U.S. Department of Justice.
Which creates incredibly high switching costs.
Yep. Once an operator integrates this software, they aren't going to leave because the compliance protection is too valuable. It's like having the world's strictest VIP bouncer at the door of your casino. It actually makes the club more exclusive and less risky to run.
That's a great way to put it. The compliance isn't just a feature, it is the core product. Smaller competitors simply cannot afford to build that level of sophisticated, auto-blocking regulatory tech. That creates a massive moat. But operational maturity on a global scale doesn't mean much if the actual stock structure is broken.
Which brings us to the elephant in the room. Moving over to the technicals and price action.
The reverse split.
The reverse split. We have to talk about what happened on March 3, 2026. Meridian Holdings executed a 1-for-12 reverse split. They took their massive float of 151.7 million outstanding shares and forcibly condensed it down to just 12.6 million.
Right.
So if you held 12 shares on March 2nd, you woke up on March 3rd with only one. Theoretically, the value of that one share is 12 times higher. But the mechanics of this move always send shockwaves through retail investors.
It does, and we really need to understand the psychology behind why management pulled this lever. When a company has over 150 million shares floating around, the stock often trades at a very low nominal price. It attracts high-frequency trading and retail speculation, creating wild, unpredictable volatility.
Anti-stock territory.
Exactly. By executing this 1-for-12 split, simultaneously paired with changing their ticker symbol to MRDN, the company is staging a psychological reset. They are explicitly trying to shake off the identity of a volatile, low-priced stock.
Well, there's also a very pragmatic survival aspect to this. Getting the share price up to that $7.65 mark ensures they remain fully compliant with Nasdaq listing requirements.
Right.
If your share price dips below $1 for an extended period, the exchange will simply kick you out.
That's the baseline requirement, yes. But there's a more lucrative target here. Institutional investors, the massive mutual funds and pension funds that actually move markets, often have strict internal mandates. Their bylaws literally prohibit them from buying any stock that trades under $5 a share.
So it's a gatekeeping issue.
Precisely. By engineering the price up to the $7 range, Meridian Holdings is inviting the big money back to the table. They are making the stock investable for Wall Street.
But the market's initial reaction was incredibly tense. Right alongside the split on March 3, there was a complete trading halt, followed by a resumption later. For anyone who hasn't held a stock during a halt, it is a terrifying experience. The exchange literally freezes the asset. You can't buy, you can't sell, you just have to sit and watch.
Very stressful.
Yeah. And while we haven't seen any undeniable massive volume surges confirmed just yet, the fact that the shares stabilized post-halt is highly significant.
It is the best-case scenario for a volatile event like this. When trading resumes after a major structural change, you often see violent price swings as algorithms and panicked retail traders dump their positions. The stabilization proves that the market is calmly digesting this brand-new corporate identity.
Setting the stage.
Right. The foundation is set for potential breakout momentum once the broader market fully understands the turnaround. Let's shift gears and look at the market sentiment and upcoming catalysts.
Good idea. Because measuring the market's current sentiment is really tricky right now. If you pull up the standard quantitative sentiment score from Meridian Holdings, it sits at exactly 0. It's perfectly neutral.
Yeah, but this is a fantastic example of why you cannot blindly trust algorithms.
Completely agree. That 0 score is purely procedural. The data scraping algorithms see a trading halt, they don't see a press release about an earnings beat, so they default to neutral. It doesn't mean investors don't care. It simply means the computer models are paused, waiting for the dust to settle.
You have to look past the algorithmic score and read the broader industry narrative. Across the gaming sector, the rebrand to Meridian Holdings is being hailed as a significant milestone. It's widely recognized as the final definitive stage of integrating Meridian Bet. And if you want proof that this was a carefully orchestrated plan and not a last-minute panic move, look at the executive suite.
You're talking about the leadership stabilization late last year?
Exactly. In December of 2025, just months before this massive split and rebrand, they appointed William Scott as the new president and CEO and brought in Rich Christensen as treasurer. You do not attract serious executive talent to a sinking ship.
Sure.
These appointments signal that the insiders were fully aligned on the structural overhaul. They installed a team specifically equipped to manage a newly cleaned-up balance sheet and execute the next phase of global expansion.
If you're looking at setting up a position here, you need to know exactly when that execution is going to be tested. The catalyst calendar over the next 3 to 6 months is stacked.
Very stacked.
The absolute biggest milestone is their next earnings report projected for the first quarter of 2026, which should drop in late May. Management set a very high bar with that $400,000 profit in Q3. The entire market is going to be watching in May to see if they can maintain that profitability or, better yet, accelerate it under the new MRDN banner.
And we have to view those upcoming earnings through the lens of the current macro environment. The wind is entirely at their backs right now. We are witnessing a massive sector rotation into gaming and e-commerce, driven almost entirely by sweeping international deregulation.
It's a huge shift.
Governments across Latin America and Africa are waking up to the massive tax revenue potential of regulated mobile gaming.
It's a gold rush.
Yeah.
We are seeing countries that previously had total bans on gambling suddenly drafting comprehensive regulatory frameworks.
And this is where Meridian Holdings' footprint becomes incredibly valuable. When a new country in South America deregulates, a U.S.-centric company has to spend hundreds of millions of dollars building local infrastructure, applying for licenses from scratch, and learning the cultural market dynamics.
The Meridian is already there.
Exactly. They already have the multi-jurisdictional licensing. They already have the localized consumer platforms. When a market opens up, they don't have to build the plumbing. They just turn on the tap. The operating leverage they have in emerging markets is staggering.
Okay, I'm going to take a hard pivot here. We've laid out the turnaround, the margins, and the macro tailwinds. But let's play devil's advocate and dive into the bear case.
Let's do it.
Because investing is entirely about managing risk. And there are some glaring, flashing red lights in this setup that we cannot ignore.
Let's pull it apart. What is the single biggest risk factor you see right now?
It's the psychological stigma of the split. I cannot understate this. A 1-for-12 reverse split is historically viewed by the broader market as a massive red flag. It is the classic signature of a dying company trying to artificially inflate its share price just to delay bankruptcy or delisting.
Right.
Because of that history, retail investors have deeply ingrained fears of shareholder dilution.
The dreaded death spiral.
Yes, exactly. The fear is that a company executes a reverse split to reduce the share count, only to immediately authorize millions of new shares to raise capital, crushing the current investors all over again. If that fear takes hold of the market narrative, it will heavily pressure the sentiment, regardless of what the underlying fundamentals are doing.
Which leads to gap risks.
Yeah, and when you combine that fear with the trading halt volatility we saw on March 3rd, the short-term gap risk is immense. You could buy this stock today and wake up tomorrow to see it gap down 20%, simply because retail traders panicked and hit the sell button before the fundamentals even had a chance to speak.
The gap risk is real, and the historical stigma of a reverse split is undeniably negative. But there is a very powerful counterargument when you look at the specific context of Meridian Holdings. This was not a split executed in isolation by a desperate company bleeding cash.
How so?
This was a split paired with a 37% reduction in total debt. It was a split executed on the heels of a transition to actual net profitability. And it was paired with a strategic rebrand designed to attract institutional capital.
So you're arguing it's a split from a position of strength rather than a position of weakness.
Precisely. Because of all the positive structural changes happening simultaneously, there is a very strong case to be made that the typical dilution fears and reverse split stigmas are already priced into the current valuation. The market knew this restructuring was coming. The underlying health of the balance sheet can actually support this new, higher nominal price tag.
That makes sense.
So what's the final verdict on Meridian Holdings? Let's look at the score. Based on the fundamental data, the aggressive debt reduction, and their dominant positioning in emerging markets, MRDN officially earns a bullish score of 7 out of 10.
A 7 out of 10. That is a highly confident rating for a company navigating this level of transition.
It really is. If we had to distill this entire analysis into an elevator pitch, it comes down to execution. The rebrand and the 1-for-12 split are the final definitive steps of the Meridian bet integration. They aren't selling a story about future profits. They already proved the model with a $400,000 net profit turnaround in Q3.
Showing actual numbers.
Right. They trim the fat with a 37% debt cut, leaving them with a highly manageable balance sheet. And they possess an incredibly deep multi-jurisdictional moat that effectively locks out smaller competitors. The structural heavy lifting is done. They are perfectly positioned to capture the acceleration in global gaming.
Which gives you, the listener, a very clear, actionable target horizon. The optimal setup here is a swing trade heading into those Q1 2026 earnings. We are looking at a 3 to 6 month target horizon. The strategy is to let the emotional dust settle from the reverse split, let the institutional investors slowly build their positions in the new MRDN ticker, and wait for the late May earnings report to officially validate the turnaround.
As you digest all these numbers, I want to leave you with a broader concept to ponder. We spent a lot of time on the mechanics of the stock, but look at the macro picture. With international deregulation currently sweeping across massive emerging markets in Latin America and Africa, consider the infrastructure required to capture that growth safely.
It's monumental.
It is. Could Meridian Holdings' hyper-compliant, multi-continent B2B and B2C ecosystem actually become the definitive blueprint for the future of international iGaming? Are we looking at the foundational architecture for the next decade of digital casinos? It is a fascinating question to consider as this space evolves.
That is the perfect thought to leave on. As usual, before we sign off, subscribe, like, and comment to this video to support the channel. Let us know in the comments if you are buying into the Meridian turnaround or if the reverse split volatility is keeping you safely on the sidelines. Thanks for joining us, and we will catch you on the next one.